Good morning, everyone. Just thinking here, the subscriber asked me when we did a video. Subscriber asked me, hey, can you talk about net expense ratios? Okay, so net expense ratios are attached to mutual funds as well as ETFs and index funds. Okay, so here I'm at the dealership getting some service done on my vehicle. So I figure I got a little bit of time to actually explain this, okay? Because tonight at 7 p.m., 7 p.m. Central, I go live to give you more great financial information. But nonetheless, net expense ratios, okay? They're collected from the total annual operating expense after waiver and expense reimbursement for the fund's most receipt prospectus for the total amount. Okay, let me break this down a little bit better because I know that can go over a lot of people's head because, again, that's just kind of the book answer, okay? So, with that being said, a good expense ratio is anywhere from 0%, which you'll never get because there's always an expense ratio. If someone in a mutual fund, an index fund, or ETF fund says that the expense ratio is 0%, I'll be very skeptical about that amount. But usually, a good expense ratio, either the three types, the exchange traded fund, the index fund, or the mutual fund, is usually anywhere from 0.5% to 0.75%. And most likely that could be on an actively managed or a passively managed account. So anything over 1% or 1.5% is considered a high expense ratio, okay? It is considered a high expense ratio if it's over 1%, and also 1.5%, okay? So anything higher than those two amounts, that's considered a very, very high expense ratio. Now, expense ratios for mutual funds is typically higher than those expense ratios for ETFs and index funds. And you guys already know this because it's an actively managed account where index and ETF funds, now, there are some ETF funds that operate like a mutual fund. So you have to be very cognizant of that because if those mutual funds operate, excuse me, I've got the camera going everywhere. If those mutual funds if those ETF funds operate like mutual funds, then you're going to get those same expense ratios that have actively managed. So you have to be very cognizant of that, okay? So I know I'm walking around just making so people don't think I'm trying to do anything crazy, black man with a hat with all black on. But anyway, let me get back into it. So we understand that mutual funds, ETFs, are a lot higher than your index and ETFs, okay? Because index funds and most ETF funds are what you call passively managed. That means that a broker or an investor is not switching out stocks within that fund. Because first and foremost, we understand that any of these funds, mutual fund, index fund, ETF funds, that they are a basket of stocks, usually within the same sector, industry, okay? So they're going to be closely related. Yesterday, I did a video about an ETF that included Tesla. So look for that video as well, okay? So let's break this down even further for those people who ask me about net expense ratios, because we understand that the expense ratio formula is calculated, okay? Listen to this. It's calculated by dividing the fund's operating expense by the average value of the fund's assets. And you're probably asking, where do I get that information? So I do heavily ETFs with Vanguard. So you will go to Vanguard and they will provide all that information on their site, okay? Does expense ratios matter? That's a good question. Do expense ratios matter? Well, expense ratios do matter because essentially it's like going into a store and you're trying to buy whatever item or whatever product, but you don't look at the price. You don't look at the price of the item. You're just picking it up. So you don't even know how much money you're spending. So that is a kind of a shoe analogy or store analogy of how expense ratios are very important. You don't know what you're buying. You don't know how much it's going to cost to operate this particular thing and how much it's going to cost you over the course of time. So you have to be very, very aware of that too. Then you also have what you call the gross expense ratio and then the net expense ratio, okay? Now, the gross expense ratio is the total percentage of a mutual fund's asset that are devoted to running the fund. Again, is a total percentage of a mutual fund's asset that are devoted to running the fund. And then the net expense ratio includes trading costs and any reimbursement and waiver. Okay? So that's basically net expense ratio, or ratios in its totality. Hopefully that I explained that. Now, anything that I said, I know it's like cold out here. It's like 37 degrees. I'm a up north guy. I'm like, oh man, you should be impervious and you should be impervious to the cold. Nah, man, we wear jackets, coats, and we stay inside with the heat on. But nonetheless, I thought I should give that video because one of my subscribers asked for it. And guys, at any time that you have a suggestion or information you want to be broken down, I try to break things down very, very simple. So if you're looking at this videos over what, 5-6 minutes, I'm just gonna break it down like this. I'm gonna break it down like this. If you went out and got internet, right? You got the router, you got the modem, right? And so you have internet, but you have to pay AT&T, Comcast, Time Warner, Cox Cable, whatever local internet company you have. You have to pay them for that service. So when you go out and buy a mutual fund, we know that this is an investment, but you have to pay them the expense ratio amount, what is essentially the operating cost of them choosing and picking stocks for that fund. So you're paying for their service. That's basically it. Ain't nothing free, bruh. You guys have a great, wonderful morning. I might be on to give you another quick tip for financial information, but nonetheless, this is Ross World. I keep saying this is Ross World, still Ross World, right? This is Financial Literacy 101. Learn money and be inspired. You guys have a great day.